And welcome back, options traders, and happy Monday. I hope everybody had a great weekend. And a question that I get a lot is, will an upcoming dividend affect your options price? And this is something that a lot of times new traders get concerned with because they hear that on the X date, when this dividend is paid, that the stock's price is reduced. And is that going to harm their call option? Or will it benefit their put option? Well, let's go have a look. So when we're talking about dividends, remember that they will reduce call prices and increase put prices. This is assuming everything else is constant. And the reason for this effect is that when the dividend is paid, the stock's price is reduced by the amount of the dividend. It has to be mathematically. If the stock is currently worth $100 per share and the company pays out a $1 dividend per share, well, that's $1 per share less value that the company has. It just mathematically makes sense that that has to be subtracted out of the current stock price. So lower stock prices reduce call prices and increase put prices. So again, we're looking at this question, should you be concerned about an upcoming dividend? Should you bail out of your call options because you're afraid that that options price is going to fall? Or conversely, should we go out and buy put options, thinking that when that stock's price drops that we're going to get this free windfall? Well, obviously that would be too good to be true, so hopefully you see where this is going. It's a little bit of a trick question, but what we're looking at here is the difference between known dividends versus surprise dividends. And so if dividends are known, they're factored into the current option prices. So by a known dividend, we mean that this is a recurring dividend. There are things that investors know about probably on January 1st. And in fact, this dividend has probably been paid every single quarter, possibly for years. The market knows about them. So these are just your plain old ordinary recurring dividends. Now it is true if you get hit with a surprise dividend or a special dividend, yes, that's going to reduce those call prices and bump up the put prices. But the very second that news is announced, that's also going to get quickly factored into those option prices, and there's really nothing you can do. But those could certainly have an effect on your option prices. But if they're known dividends, not so much. So let's see why. Let's say that we have a stock trading at 100, and to make the math easy, we've got 1 year to expiration, interest rates are 5%, and let's say that a $2 dividend is paid annually, just one-time dividend paid annually. Well, if it's paid in 1 year, it's obviously not worth $2 today. And that's because of the time value of money that I've talked about before. So if it pays $2 in 1 year, what's that worth today? Well, we simply take $2 divided by 1 plus the interest rate. So 2 divided by 1.05 is $1.90. So what this means is that, yeah, we might receive $2 in a year, but that's really worth about $1.90 today. And that's because theoretically we could take the $1.90, invest it at 5%, and end up with the $2 in a year. Two different ways of looking at the same cash flow, just at different points in time. So if the market knows that a $2 dividend is going to get paid in a year, the market would say, okay, we know that's worth about $1.90 today. They'll just subtract it off the current stock price in a pricing model. So if we have a $100 stock minus $1.90, that's worth about $98.10. So if you have a pricing model that doesn't allow for dividends, just do this calculation, use $98.10 for the current stock price, even though it's actually trading for 100. Now another thing to watch out for, that unless you tell the model when the dividend is paid, it might just assume that it's paid somewhere between now and 1 year. In other words, on average in a year. So it would probably assume that it's paid in 6 months. So in that case, we might say, all right, let's look at a 5% interest rate, but if it's going to get paid in 6 months, that's only half a year. So 5% divided by 2 would be 2.5%. So we'll do the same calculation, $2 dividend, but now we're going to divide it by 1.025, just 0.05 divided by 2. That's going to give us a little higher present value of $1.95. So we take the $100 stock minus $1.95. We could put $98.05 into the pricing model, and that should get us really close to the current market prices for these options. But theoretically, this is what the market is doing with these known dividends. And so that's why once the dividend is paid, don't expect your options prices to move just from that dividend. Now, obviously, you've got daily news coming in and out, you've got volatility, you've got a lot of different things that could affect that stock's price. But it's not going to be from the payment of the dividend because the market knew about it. So to see how this works, let's go over to the OIC's website and do some examples in a pricing model. Okay, so now we're into the OIC's website. That's the Options Industry Council. You can find them at optionseducation.org. They've got a nice little pricing model that we've used in previous videos. So for starters, let's say the stock is 100, strike is 100, 360 days to expiration, 20% volatility, 5% interest rates. And for right now, I'm going to say no dividends. If we click on calculate, it tells us the call should be worth about 1033 and the put should be worth about 607. But now let's put in a $2 dividend. Right there says dividend amount. Choose calculate, and now it reduces the call's price to about 912, maybe 913, and bumps up the put's price to about 665. So you can see the presence of a dividend reduced the call price and increased the put price. But how could we get these same numbers if we didn't have a dividend feature in a pricing model like this? So remember these prices, let's call it 912 and 664. Let's blank this back out, go back to 1033 and 607. Well, in the presentation, I said you could take the $2 dividend divided by 1.05, and that would give you $1.90, or a stock price of $98.10. So watch, we can get the same answer if I put the stock price at $98.10, leaving everything else the same. And we come up with about $9.16 and $6.90. So we're a little bit off, but part of the problem is what I also talked about, that the model doesn't know when this dividend is paid. Now, in this model, we could come in here and tell it when it's paid. We can even give it a specific date. But in the absence of that, the model's usually going to assume that it's paid somewhere along the way, on average. So we would say 6 months. So if we go back to taking the $2 dividend divided by 1.025, that gives us $1.95 for the present value of the dividend and a stock price of $98.05. So let's reduce this a little more, $98.05. And so there it is, telling us the call price is about $9.13, which is what the model gave us before. But notice that the put price is still a bit higher. It's at about $6.93, whereas it was about $6.65. And part of the reason here is that because this is an American put option, that there could be a benefit for early exercise and investing the cash. So we have to account for that additional benefit. But the main thing that I'm just trying to show you is that if the market knows about the dividends, this is how they get factored in. The market just takes the present value of these dividends, uses that for the stock's price, and then that's part of what you're seeing on your quote board. So if you have a call or a put, and it's just a plain old ordinary dividend, something the market has known about for a long time, don't worry about having to close your option, and don't worry about going out to buy puts thinking that you're going to get free money. It's already factored in to the option's price. And probably the most important point to remember is that the market is forward-looking. And if it's information that the market knows today, it will get accounted for in today's prices. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.